What if I told you the difference between buy and sell isn't just a button? It's a heartbeat of every profit, every loss, and every lesson the market forces you to learn. I'm Alfred Mugo, and this isn't your typical Forex channel. Hey, we don't just trade currencies. We dissect the psychology, the patterns, and the raw human drama behind every pip. You'll see 3 words everywhere here: buy, sell, success. Think of them as the 3 pillars of trading. Not just actions, but a language. Buy is the art of timing. Sell is the discipline of exit. Success? That's a relentless grind of aligning both. Now, let's address the elephant in the room. Yes, this is an AI voice. But don't mistake synthetic tone for synthetic truth. Every strategy, every insight, and every brutal lesson shared here is forged in real markets. Sleepless nights, blown accounts, and hard-won wins included. Today, we're ripping open the myth that Forex is about guessing games or guru prophesies. You'll learn why buy and sell decisions aren't about luck, but about reading the market's pulse, the way price hesitates at key levels, the way news events send shockwaves through currency tides, and the way your own psychology can hijack your trades. By the end of this video, you'll see those buy and sell buttons differently. They are not just clicks, they are declarations of confidence, shaped by clarity. Let's turn your next trade from a gamble into a calculated move. Ready to decode the signals hiding in plain sight? Let's go. Why success isn't a straight line. Success in Forex isn't a tidy upward climb. It's a messy, winding journey. Imagine navigating a stormy sea. Some days you'll ride waves of profit, while other days you'll be battered by losses. Volatility isn't just a market feature, it's your greatest teacher. For instance, a 100-pip swing might feel like a disaster in the moment, but it often reveals hidden market patterns and opportunities for growth that you might have otherwise overlooked. Market cycles shift relentlessly. The euphoria of a bullish trend can vanish overnight when geopolitical news hits or unexpected economic data is released. Remember the 2023 US dollars collapse after the Fed surprise rate pause? Traders who recognized the signs of weakening momentum before the headlines emerged were able to safeguard their capital, demonstrating that successful trading often requires keen observation and quick adaptation. Emotional resilience is your anchor in these turbulent times. When pound sterling to US dollar nosedived last month, seasoned traders didn't panic. They pounced. They had conditioned themselves to view sharp drops not as failures, but as opportunities to reposition their portfolios and refine their strategies. This resilience, built through experience and continual learning, is what ultimately separates consistent winners from those who get swept away by the market's whims. The psychology of buy and sell decisions. Every click of buy or sell is a battle between logic and emotion. FOMO, fear of missing out, often lures beginners into chasing trends, while overconfidence can trick them into ignoring critical stop losses. It's important to recognize that each decision is layered with complex emotions and biases that can cloud judgment. Cognitive bias alert. Ever held onto a losing trade, hoping it would rebound? That's the sunk cost fallacy at work, where you invest further based on past investments rather than the future potential. The overconfidence trap. A winning streak isn't necessarily a reflection of skill. It's often luck. I learned this the hard way, blowing $5,000 on euro to Japanese yen during what I thought was a hot streak. This experience taught me that humility and constant self-assessment are essential for long-term success. Pro tip: keep a trading journal. Record not only your trades but also your emotions and mental state at the time. Over time, you'll notice patterns. Perhaps fatigue leads to reckless decisions, or unchecked greed overrides your established strategy. The market is a reflection of human behavior. Markets are a mirror of collective emotion. When the ECB hints at rate hikes, optimism can drive EUR rallies, while in times of conflict or uncertainty, fear can tank risky occurrences like AUD. Understanding this interplay can give you an edge in anticipating market moves. Optimism peaks. If you see a currency pair surge on positive GDP data, that's often the crowd buying into hope, driving the price higher than fundamentals might suggest. Pessimism valleys. Conversely, a sudden drop in oil prices might trigger a panic-induced sell-off in CAD, as traders overlook the country's broader economic strengths and diversified portfolio. Case study. In 2024, rumors of a U.S. recession led to a swift USD sell-off. However, Savvy traders recognized that the panic was disproportionate to the actual risk and bought the dip, knowing that market sentiment often overreacts before correcting itself. How to analyze market sentiment. Sentiment is the market's heartbeat. Tools to gauge it include news scanners, platforms like Forex Factory that track high-impact events, offering real-time insights into market-moving news. Social media. Channels such as Reddit's All Forex or trending topics on Twitter reveal the collective mood of retail traders, which can be a useful contrarian indicator. COT reports. These reports detail how institutions are positioned, whether they are net long or short, and can be an invaluable guide in understanding market dynamics. For example, if the COT report shows hedge funds heavily shorting GBP, yet positive Brexit developments emerge, it might be the perfect moment to go long. Contrarian moves like these often pay off when the broader market sentiment shifts. A bridge between beginner and expert. Theory forms a foundation of your trading strategy. Before diving into technical indicators like MACD or Fibonacci, ask yourself fundamental questions. Why does the USD often strengthen during global crises? Hint, it's seen as the ultimate safe haven. What drives a JPY's inverse relationship with risk, especially during periods of market stress? Consider the unwinding of carry trades. Action step. Choose one currency pair and study its historical performance. Examine how it reacted during the 2020 pandemic versus the 2022 energy crisis. Recognize that patterns often repeat themselves, providing valuable clues to future behavior. Building a trading plan that works. A well-structured trading plan isn't just a suggestion. It's your lifeline in the chaotic world of Forex. Your plan should clearly outline risk per trade. Never risk more than 1 to 2% of your total account on any single trade, ensuring that one bad move doesn't wipe out your capital. Entry or exit rules. For example, buy only if RSI is below 30 and price bounces off a strong support level. Time frames. Understand whether you're a scalper using 5-minute charts or a swing trader relying on 4-hour charts to determine your strategy. Pro tip. Always backtest your trading plan on historical data. If your strategy didn't hold up during past events like the 2015 Swiss francs crash, it's time to revisit and revise your approach. Common pitfalls every beginner should avoid. Overtrading. Remember, 10 trades a day do not equal success. Quality over quantity should be your mantra. Ignoring stop losses. That hopium trade, where you hope for miraculous turnaround, can ultimately lead to devastating losses. Chasing losses. Doubling down after a loss is more akin to gambling than trading. Real talk. I once ignored stop losses in 2022 and ended up losing 30% of my account in just 1 week. That painful lesson drove me to always set stop losses before entering a trade, ensuring that risk is managed from the outset. Conclusion. An invitation to think differently. Trading isn't about predicting the future. It's about preparing for it. When you click buy or sell, you're not simply reacting to price movements. You're engaging with the very essence of human nature. Every chart, every trend, every breakout or breakdown reflects a collective psychology of the market, where greed, fear, euphoria, and panic intermingle in real time. Most traders fail not because they lack technical skills, but because they misunderstand the true nature of the game. It's not about outsmarting the market. It's about understanding its rhythm, its subtle cues, and its underlying sentiment. Knowing when to act and, equally importantly, when to hold back is a skill that distinguishes the successful from the impulsive. Patience, too, is an asset. Sometimes the best move is no move at all. So, my challenge to you is this: don't just trade, study, observe, and think beyond the immediate price chart. Ask yourself why certain patterns are emerging, who is influencing the market dynamics, and what emotions are currently at play. This deeper inquiry is what transforms a routine trade into a strategic move. Remember, the most powerful traders aren't necessarily the ones who make the most trades. They are the ones who make the right trades. They act with precision, avoid impulsiveness, and prioritize mastering their emotions before the charts. As you continue on your trading journey, refine your strategies, learn from every experience, and always remain adaptable to the ever-changing market landscape. If you're eager to keep sharpening your skills and developing your mindset, stick around. There's a wealth of strategies and insights yet to uncover, and I'm here to help you navigate them. Drop a comment with your biggest Forex challenge, and let's explore solutions together. Until next time, trade smart, stay disciplined, and let the market come to you.